Hey, what's going on, guys? Stock market is booming. S&P 500 reaches one all-time high after another. Everything seems like a flowers and rainbow on the street. But if you look under the cover, that colorful rainbow turns into dark nightmare. In this video, I will explain why current monetary policies are failing and what are the implications of those policies. According to Trump, economy is booming and S&P 500 reaches new all-time high. As of the time of this video, it reached $3,280 a share, which is a record high. We are into 11 years of the biggest stock market growth and economics expansion in the history. At the bottom of 2009, right after housing bubble and global financial crisis, one share of S&P 500 was trading around $700. From 2009 until 2020, that would be 4.7x return on investment or 370%. That's over 13% annual rate of return on average for the past 11 years. Historically, S&P 500 returns 8 to 9% on average. This past decade was very extraordinary, mainly because of the low interest rate environment and consistently printing large sum of money which injected straight into equities. Currently, Fed injected billions of dollars into repo market daily. So no wonder why the stock market is at all-time high. Speaking of all-time high, it looks like we are going parabolic. I do not think we have seen, at least for the past 25 years, such a parabolic year in the stock market. In January 2019, one share of S&P 500 was trading around $2,400 a share, and 1 year later it closed to $3,300. That's close to 900 points increase within 1 year, or 35% return on investment. This is what usually happens in the latest stages of the market cycles. If you look at this chart, my best guess would be that we are currently in a greed or delusion phase. But I do not really like to rely on price movement only. I really like to look under the cover and see what is really going on in the stock market and economy fundamentally. As I mentioned earlier, we are mainly going to focus how current monetary policy is failing. Shout out to Real Vision, they always bring very informative content. I took 2 clips from the interview with Simon White, a co-founder of Variant Perception. He explains how the wealth inequality and deflationary pressure builds because of these failing monetary policies. This video is presented by DueDex. DueDex is reliable and trusted cryptocurrency exchange with up to 100 levered swaps. It has a new and unique feature where you can amend your order price by dragging and dropping on the chart. It is very useful and easy. Use the link in the description box below, sign up and get $10 bonus. Deposit 0.1 BTC, get $50 bonus. Deposit 0.2 BTC and get $100 bonus.
So current monetary policy, I think, is failing for a number of reasons. We've been in this situation since the great financial crisis. We've had so-called unconventional monetary policy. We've had lower and lower rates. We've had zero rates. We've had negative rates. And we've also had large-scale asset programs, quantitative easing. And they really haven't worked. And the reason is the fundamental issue here is the private sector is desire to run a savings surplus. So the private sector, since the great financial crisis, has been running a savings surplus. Now, there might be a number of reasons for that. I'd say foremost might be the fact that the financial crisis was so severe, it basically created such an effect on these companies. They're still licking their wounds and still trying to rebuild their balance sheets. So monetary policy is really there to try and, if you like, persuade these companies to try and reduce their savings surpluses, and that is what it's not been able to do. You take lower rates, that's basically not worked for 3 main reasons, I would say. So the first of all is what's called the income substitution effect. So the closer you get to the zero bound, when you have a sector that desires to save, that means that they have to essentially save more and more to maintain the same level of income. So it starts becoming counterproductive. The second thing is the wealth effect. You're seeing greater wealth concentration across the world. And again, you can speculate some of the reasons. You might say that, for instance, if you look at the tech companies, it takes fewer and fewer people to create, a lot more capital than it used to. You could also blame monetary policy itself, QE, for the rise in wealth inequality. And that means the pervasive impact of lowering rates is much less effective than it once was. Take QE, the other main policy that we've seen since the great financial crisis. Now, that's also been ineffectual in trying to persuade the private sector to reduce its savings surplus. All it's really done is cause the private sector to change the composition of its savings. So the central bank buys government debt, it bids up government debt. The private sector basically then exchanges one savings vehicle, which is government debt, for another savings vehicle, which is reserves. So the overall level of savings remains the same, but the composition changes. And as I mentioned earlier, you have the kind of political toxicity effect from QE because it's probably adding to a huge amount of wealth inequality. So it's quite clear from these reasons that monetary policy, current monetary policy, isn't working. And the third reason, and this is the one that's obviously in vogue quite a lot today, is negative rates. They, if anything, are deflationary. And the main reason is because of the impact they have on banks. Banks under conventional monetary policy are the transmission mechanism. So they're the things that you're supposed to transmit monetary policy. But when you have negative rates, because banks are kind of loath to cut rates to negative on retail depositors, their net interest margins are getting squeezed, and they're getting squeezed further and further. And that means ultimately they have lower profits, they have less retained earnings, and then that means that ultimately they can lend less. So the whole thing starts to become counterproductive. And in fact, there was a good piece of research from the University of Bath recently, and they looked at 7,500 banks across 30 OECD countries, banks that have been impacted by negative interest rate policy. And over the period of negative interest rates, on average, their net interest margins fell by 16%, and their return on assets fell by 3%. So it's kind of clear that these policies not only aren't working, they're becoming counterproductive.
First and foremost, very low interest rate and even negative interest rates do not even work anymore. They cannot really stimulate further economic growth. Currently, we are sitting at 1.5% Fed fund rate, and most likely we will go even lower. And then what? Let me give you a simple analogy. It's like you have addiction to caffeine. You continuously drinking multiple cups of coffee every day, but in the end of the day, you're still tired. It's because your body doesn't respond to that stimulation anymore. You are immune to coffee. So what is the solution? Stop drinking coffee for a period of time and then reintroduce it again in smaller amount. Hopefully, if you did not fry your nervous system yet, then you will still get some stimulation. If Fed would increase interest rate, yes, we would probably suffer some downturn for a brief period of time, but it would be more beneficial for a long run. As Simon White mentioned in the interview, that negative interest rates can create deflationary state in our economy and negatively affect on banking system. Because banks create profit based on the difference between lending and borrowing, and therefore their margins getting squeezed further and further. Eventually, they will generate less profits and stop lending, and it would become counterproductive. The velocity of money within consumers would decrease and create deflationary state. The only thing that still works is QE. I know Fed doesn't want to call it QE anymore, but this is like QE on steroids. They continuously printing US dollar and injecting billions into repo market daily, which also create wealth inequality. Let's take a look at this chart. 99% of the middle class and low class people own around 43% of wealth in the United States, comparing to 1% of upper class owns the remaining 57% of wealth. If you do not really understand what that means, it means that small number of rich people own more than 50% of Americans' wealth, while hundreds of millions low and middle class people own the remaining 43%. And by the way, wealth inequality continues to diverge. Let's take a look what are the market implications of these policies.
So what's the implications to markets for these sort of policies? Well, I think that it's going to turn a lot of things on its head. But I see three main kind of structural themes from this shift away from conventional monetary policy towards MMT-like policies. And just to make something clear, this isn't going to happen overnight, and we're not going to hit full MMT overnight, but there's a clear kind of progression towards these sort of policies. And the three main structural changes I foresee is the long boom in financial assets versus real assets, I think, will come to an end, and real assets will begin to outperform financial assets. I think cross-asset volatility will begin to rise on average, and I think we'll see more frequent bursts higher in volatility. And also I see, because the tail risks are shifting from lower inflation to higher inflation, that means that the risk of higher short-term rates will be higher. So that makes leverage a much more of a dangerous game. So when it comes to financial assets, why are they going to begin to underperform? Well, you look back to the 70s. 70s is a great kind of poster child for, long-term kind of high inflation, that was pockmarked with double-digit inflation and stagnating growth. And you look at which assets performed the best, which asset classes performed the best and the worst. Best performing assets were commodities, and the worst were equities. And in fact, the only asset that actually gave you a positive real return in that decade was commodities. Equities, on the other hand, became like a shunned asset. Very simplistically speaking, if you think about an equity as a kind of infinite maturity bond, you had the higher rates to deal with inflation. The present value of these things just got absolutely decimated. Nobody wanted to hold them. And even though in price terms, the market bottomed in 1974 in equities, PEs didn't actually bottom until the early 80s. So they really were not an asset that people wanted to hold, collectively speaking. But within equities, there was actually some quite interesting trends. So the equity sectors that did the best were the ones that either owned real assets or benefited from real assets. So energies and industrials did the best in that decade. They were the best performing sectors. At the other end of the scale, you had the banks. The banks, really struggle. Banks are kind of nominal machines. They borrow short term and they lend long term, and they're in a very difficult environment, in rising rate environment. And it kind of makes sense, going forward. Banks have kind of benefited from this, low rate environment where they're able to provide leverage to boost financial assets. If these things go into reverse, the kind of whole business model of banks is going to be challenged. They're going to find life much more difficult unless they overhaul their business model. And another, I think, very important theme here is the kind of traditional portfolio construction. I think that's going to come under immense pressure. So you have risk parity, or you have the traditional 60-40, which is kind of risk parity-like. They've benefited for years from the negative correlation of stocks and bonds, but that's not really the normal state of affairs. Over the last 100 years, 70% of the time, that correlation has been positive. And what you notice is that as rates go higher and inflation heads higher, and that's what you'd gradually expect to see under MMT, that correlation reverts back to positive. And that whole concept where you're benefiting from the diversification effects doesn't exist anymore. And that has great changes for the markets too, because the 60-40 kind of thing, that's been a major kind of volatility dampener for the markets, right? Along with the risk parity. Whenever volatility falls, they essentially have to buy more assets to rebalance. So there's this kind of self-fulfilling effect. So these guys are essentially short vol, and they're short stock bond correlation. And as these things reverse, you expect all these things to begin to go higher. So really kind of challenging what people's general kind of view of markets have been for the last 30 or 40 years.
Commodities and equities dispersion is really wide. Let's take a look at this chart. For the past decade, stock market skyrocketed, while commodities either decline or were fluctuating sideways. It's probably the best time to own real assets, especially that we are anticipating some type of recession in the near future. I would recommend owning some gold, silver, and Bitcoin. Gold, silver, and Bitcoin are the only assets in the world that simultaneously are not third parties' liability. If in financial world banks stop working, it will have systematic effect on all other sectors that have some relation with banks directly or indirectly. Precious metals and Bitcoin are not exposed to that risk. Let me know what do you guys think about these failing monetary policies. Leave your thoughts in the comment section below, hit that like button and subscribe.